In this video, we will discuss the conceptual overview of responsibility accounting. Okay, so first, let's define what is responsibility accounting. Responsibility accounting is an accounting information system and a managerial control device that involves identifying responsibility centers with their corresponding objectives, developing measures of achievement, and preparing and analyzing responsibility reports in every responsibility centers. So for short, this responsibility accounting is actually concerned with designing reports that help motivate managers to make decisions and to take actions that are in the best interests of the overall organization. The concept of responsibility accounting revolves around the concept of decentralization in organization. So in a decentralized organization, there is employee empowerment, and that top management grants subordinate managers a significant degree of autonomy and independence in operating and making decisions relating to their fields of responsibility. So there are a few benefits. These are some of the benefits of decentralization. First, it motivated managers. It generates faster decisions. It comes up with enhanced specialization. There is a defined span of control. And fifth, training for the employees. Well, there are some disadvantages also of decentralization, and the most common disadvantage of this decentralization is sub-optimization and goal congruence. What is sub-optimization? Sub-optimization happens when division managers work for their own self-interest only without consideration on the benefits to the entire organization. So they are putting their attention on what benefits them rather than looking at the bigger picture. Goal congruence, this refers to a mismatch, of the manager's goals and the top management goals. So there should be the bottom line, or at the end of the day, the whole company should be benefited. And for that benefit to happen, some or one of the departments or segments or divisions should sacrifice a little bit, like reduce profit so that the other division will benefit from it and the entire company will be benefit from it also. Okay, so let's discuss responsibility centers and some of its common types. So when we talk about responsibility center, it is a subunit of an organization, like a department, division, or any segment whose manager has authority over and is responsible and accountable for that defined activities of the segment. So these are the common types. We have the revenue center. Revenue center is a segment whose manager has control over revenues alone. Cost center, also at the opposite end, the manager has control over the cost alone, not over revenues or anything. Profit center, on the third, it is a segment whose manager has control over both the costs and revenues, but no control over investment funds. And fourth, we have investment center, a segment whose manager has control over costs, revenues, and investments in operating assets. While let's have this self-check number 1. So consider the following 3 statements. A profit center has control over both cost and revenue. Statement 2, an investment center has control over invested funds but not over costs and revenue. Statement 3, a cost center has no control over sales,
Question: which statement or statements are correct? Okay, so you may answer this on your own. So if we are going to condense the 4 types of responsibility centers, let's look at them by the factors. So for the first factor, controlled by center management. Okay, so what is the thing that is being controlled by the management? For the cost center, it is the costs, the revenue, the revenues in the revenue center, cost and revenues or both, no, in profit center, and costs, revenues, and significant control over investment in investment centers. For second, financial performance measure, for a cost center, we have cost incurrence and savings. So managers are evaluated based on how they incur costs and what are their cost savings. For revenue center, the manager are being measured, their performance are being measured by at the way how they generate revenues and how they meet the revenue targets. For profit center, the manager is being evaluated by the amount of profit he or she generated, and for investment center, the manager's performance is evaluated through the income generated in relation to assets invested. So for the accounting tool for analysis, so what are the accounting tool that we will use to analyze this center? For the cost center, it is cost variance analysis, like actual versus budgeted and what is the variance, whether it's favorable and unfavorable. Revenue center, it is the sales variance analysis. For the profit center, it is the gross profit variance analysis and of course profitability ratios. For the investment center, we have return on assets, residual income, and economic value added. Okay, so these are the important reminders for our responsibility report. So our responsibility report must be segregated into first, controllable costs. What are controllable costs? So these are costs that can be controlled or regulated at a given level of managerial authority. So what are the costs that the manager can control? For example, in a printing division, so you can control there the the papers or the ink level. So you will have quality check before you print so that there will be no waste or no results to wasted papers or printed material. So those are just the example. For second, non-controllable costs, so these are costs whose occurrence is beyond the managerial level of authority of a certain organizational unit. So what are the example of a non-controllable cost? So like whatever we do, we really cannot control those costs. So these are some of the fixed costs that still happen whether or not the manager exerting effort to that. Okay, like plant insurance, okay, and others. For the third, direct costs, these costs are identified or identifiable with a particular activity or cost center. So for example, in a printing division that I have made mention a while ago, direct costs are the printing costs, like the materials and the printing labor. Okay, for the indirect costs, so these are the costs that are not easily attributed to a particular activity or cost center. So they are incurring this, but not necessarily directly, attributed to the activity. So, like for instance, if they are hiring an HR agency to manage your employees, the company employees. So, whatever is the salary of that HR manager will be a part actually of each division, but it is not directly attributed to the printing division or to the binding division, no, because it is general. Okay, fifth, we have traceable fixed costs, no? So these are the fixed costs that are incurred because of the existence of the segment or activity. So for short, this cost will disappear if eventually that segment will disappear. So for example, we have a like microchip division. So if you will eliminate the microchip division, then there will be no fixed salary for the microchip division manager. So that is an example, no, of a traceable fixed cost. Now we have common fixed cost. Common fixed cost supports the operations of more than one segment or activity, but is not traceable in whole or in part to any particular segment or activity. Okay, so these are the common fixed costs that has been allocated to each division, like um, the overall president's bonus, no, managers pay, the bonus, no, the incentives, so it is allocated to all divisions. So that is an example of a common fixed cost. So let's have a self-check. Number 2. In responsibility accounting, each segment in an organization should be charged with the costs for which it is responsible and over which it has control, plus its share of common organizational costs. So, is this statement true or false? Okay, so presented here is an example of a responsibility cost report. Okay, so we can see here the actual, the budgeted, and its variance. So as we can see, we have segregated the cost as to direct costs, which are controllable and non-controllable, and indirect costs. Okay, so these are the indirect costs. Okay, so let's look later on how we do segment reporting. Okay, so this is an example of segment reporting under responsibility accounting. So for the total company, this is the figures, and it has two segments, segment X and segment Y. So for the sales for the total company, we have 500,000, which came from 300,000 generated by segment X and 200,000 generated by segment Y. We have the variable expenses, so we have the variable cost of goods sold. So for the total company, it is 180,000, coming from 120,000 from X and 60,000 from Y. We have also other variable expenses, 50,000 for the whole company, which is 30,000 incurred by X and 20,000 incurred by Y. We have the total variable expenses, so just the sum of these two variables. So we have from the cost of goods sold, the variable manufacturing, and other non-manufacturing variable costs. Okay, so we have the contribution margin. Okay, so from this contribution margin, okay, we will deduct the traceable fixed expenses. Okay, so the traceable fixed expenses that is specifically attributable to X is 90,000 and to Y is 80,000, so making up 170,000. So we derive the segment margin. So segment margin is the difference between the contribution margin and the traceable fixed expenses. So we have the segment margin 60,000 for X and 40,000 for Y. Now, next we deduct the common fixed expenses that are not traceable to the individual division, or in other words, these are the common fixed expenses. So we have 42,500. So it is just allocated, no? So this is the total, 85,000. Then commonly allocated, so equally divided among the number of segments. So we have 85,000 divided by 2. So we have 42,500 X, and same for Y. Now we have the net income. Net income, the total company's net income is 15,000, and that is attributable to 18,500 profit from X and 2,500 net loss for Y. Okay, so just remember that there are some points that we need to highlight, especially on this net income and the segment margin, which is mainly our performance measurement tool. Okay, so before we proceed, let's have the self-check number 3. So when you see segment margin figure, let's say 50,000, what does this number mean? Okay, so just answer in a brief sentence or just a phrase will do. Self-check number 4. Question: contribution margin and segment margin mean the same thing. Is this true or is this false? So now let's highlight the major points in responsibility accounting. Okay, so the proper evaluation of a segment's performance must be based on the segment's margin. So this is the segment's contribution margin deducted with the direct cost, no, the traceable fixed expenses of that segment, because it is quite unfair if the managers of segment X and segment Y will be evaluated based on the net income, because as you can see, maybe we will reward the segment X manager and we will call the attention of the segment Y manager why it has generated a loss, or maybe we will if we will base it from net income, we will have promotion for X and demotion for Y, no? Or punishment, for example. So we should look at the segment margin instead. Okay, so as long as the segment margin is positive, then the managers of those segments are actually, or those segments are performing well. Okay, so second point is that maybe the segment may have a net loss, but it doesn't necessarily mean that the segment is operating at a loss, okay, or underperforming. The loss would rather be caused by the common fixed, no, just allocated, no, which is indirect, not really related to Y, and non-controllable. Hindi talaga, not on the span of control and regulation of the manager of segment Y. So another point is that some traceable fixed costs may be regarded as common costs when we move down the organizational chart. And conversely, certain common costs become traceable or direct fixed costs as we move up the organizational chart. So for example, no, if we move up, no, for example, the bonus or the mid-year bonus or the 15th month bonus of the vice president of operations or the vice president of the company, for example, or the president, CEO of the company, it can be a traceable or direct fixed cost in the office of the chief operating manager, no? For example, we have a COO. So that bonus of our operations manager will be a direct cost to COO department. So if under COO, as we move down the organizational chart, so for example, just imagine, no, this is the COO, okay, and we have here different divisions, no? Division 1, Division 2, and Division 3. That direct cost, that traceable direct cost will be now a common cost under this, because that salary, or that mid-year or 15th month bonus of the COO will become a common cost allocated divided by 3. Okay, so that's how it means, no? Okay, class, so basically that wraps up the lesson for this lecture, and our next lesson will be lesson 2, which focuses on responsibility accounting and the segment performance evaluation techniques. In that next lesson, we will be discussing return on investment, residual income, and economic value added. Thank you for watching.